What if you could buy something cheap in one place, sell it instantly somewhere else, and lock in profit, with almost no risk? That idea is called arbitrage, and it plays a huge role in finance, crypto, and trading. Welcome to Blockboard, the channel where we make complex tech simple. Today, let's uncover how arbitrage works. Arbitrage is the process of buying and selling the same asset at the same time in different places to profit from a price difference. You're not guessing the future. You're taking advantage of prices that don't match yet. Let's imagine a simple city with two markets. In Market A, berries cost $30 per kilogram. Just a few blocks away, in Market B, the same berries cost $40 per kilogram. Most people shopping in Market B don't know they could get cheaper berries in Market A. You notice this difference. So you buy berries in Market A for $30 and immediately sell them in Market B for $40. That's a $10 profit per kilogram, without changing the product at all. As you repeat this every day, something interesting happens. Demand in Market A increases, so prices go up. Supply in Market B increases, so prices go down. Eventually, the prices become almost equal. And once prices match, the arbitrage opportunity disappears. This is how arbitrage actually helps markets become more efficient. The same thing happens in financial markets. Imagine a stock trading for $100 on one exchange and $100.50 on another exchange. An arbitrage trader buys the stock where it's cheaper and sells it where it's more expensive. Instantly. The profit may seem small, but when done at scale, it adds up fast. Arbitrage is often called risk-free profit, but only in theory. In real life, there are risks, execution delays, transaction fees, price changes happening faster than you can trade. That's why today, most arbitrage is done by automated systems and bots that act in milliseconds. There's also something called risk arbitrage, and this one is different. It's based on speculation, not pure price mismatch. For example, imagine news breaks that company A might be acquired. Traders buy shares expecting the price to rise. But if the deal fails, the price can fall sharply. That's why risk arbitrage is not truly risk-free. In crypto markets, arbitrage is very common. The same coin can trade at slightly different prices on different exchanges. Traders and bots constantly exploit these gaps, which is why prices across exchanges usually stay very close. That's all for today's breakdown. If this helped you understand how blockchains really work, subscribe, and stay tuned for more crypto insights right here on Blockboard.